Good afternoon, everybody. Welcome to Venable's SBA Paycheck Protection Program, How to Prepare for a Potential Audit. I'm Allison Baker, and I am going to be joined by a fantastic group of colleagues who are going to be discussing this issue today. I'm joined by my partner, Andrew Bigart, who's a partner in our financial services practice, and in particular focuses his practice on anti-money laundering laws, as well as the payment systems and payment-related matters, and of course the PPP itself. I'm also joined by Meredith Boylan, who's a partner in our financial services and litigation practice. Meredith's practice predominantly focuses on defending companies in financial services-related litigation and enforcement matters. I'm joined by my partner, Chuck Morton, who is co-chair of Venable's corporate practice, and Chuck has had a very esteemed practice and has had a very esteemed career advising lots of different types of companies, predominantly but not entirely in middle markets, and has had a lot of experience looking at how the PPP has affected those businesses and their decision making. And I'm also joined by my partner, Chris O'Brien, who is a partner in our corporate practice and is similarly been very engaged in helping advise clients of our firm over the last month on how they can best enable themselves to be eligible for the PPP, as well as to ensure that if they get that money, they are able to comply with all of its requirements. And I'm Allison Baker. I'm going to be moderating this panel today, and I'm a partner in our financial services practice. I'm actually chair of that practice. I'm also a litigator, and I predominantly focus my practice on litigation and enforcement defense work. Today, we are going to be discussing a few things. We're going to be discussing very briefly, just to refresh everybody's understanding of the Paycheck Protection Program, a little bit about the contours of that program. We're going to be discussing in greater length a fair amount about the risks around the audit potential of that program. As you know, as everybody undoubtedly knows, Secretary Mnuchin has announced, and the SBA also recently announced in its guidance, that it was the intent of that agency to audit all borrowers that receive $2 million or more from the PPP program. And so we're going to be discussing at length how you can prepare yourself for that potential audit, what that scrutiny means, and potentially what could happen if that audit devolves into an investigation. And then, of course, we're going to be providing along the way lots of practical guidance on how you can minimize your business's risks if you decide to take the PPP loan and or if you've already done so. So first of all, I'm hoping that Meredith can just give us a brief overview of what the CARES Act and the PPP provides so that everybody on the phone is oriented accordingly.
Hi, good afternoon. Thank you. I'm sure most of the people on the phone are aware of this program and why it is so attractive to small businesses. And part of the reason that it's drawing so much attention and some controversy in the media is because of its attractive terms. The loan amounts can vary up to $10 million based on the size of an employee's payroll and its prior year's payroll expenses. And the loans can be used primarily for payroll expenses, but can also be used for some other discrete purposes, including mortgage interest and rent and utilities. And the biggest draw for this funding is that there is the possibility of having the principal and interest forgiven if the funds are spent according to the rules. And even if they aren't spent according to the rules, or the forgiveness is not available to the employee, and I should say that you still have to spend the money according to the rules. But even if you are not eligible for forgiveness, there is a relatively low interest rate at 1%. So overall, this is a very attractive piece of legislation and has led to extreme interest in this program, and a lot of people have applied for it. The funding ran out. It has been refunded, replenished, and so now I think a lot of businesses that have applied have received their loan funding and are facing the next stage, which is, what do I do next? How do I work through the forgiveness piece of this, and also how do I prepare myself for potential inquiries from the government about the money, given the recent developments in the news?
Chris, I'm hoping you can walk us through some of the qualification criteria associated with receiving this loan, again, just to orient our audience as it relates to this program.
Sure. So if we take a look at slide 5, we've laid out some of the qualification criteria. I imagine most people who are listening to the webcast have already gone through this analysis if they've made an application. But just to sort of recap it, generally the applicant needs to employ fewer than 500 employees, but that's not the case necessarily for every kind of applicant. And in terms of the 500 employee count, we believe at Venable that that measurement is done at the time of the application and at the time of disbursement, not on a 12-month look-back basis. But the SBA has not completely clarified that question. And as a matter of fact, last night they propounded a new FAQ that says that foreign affiliate employees need to be counted into the 500 head count. So these rules are being modified and clarified all the time. In addition to the 500 employee head count or separate from it in some cases, if the applicant has more than 500 employees, but under its NAICS code, which is NAICS, which is a typical code used by the SBA for these purposes, there may be a separate and distinct headcount number. And to make it further complicated, if the NAICS code does not have an employee size standard, then there are some other counting methodologies like the receipts-based standard under that NAICS code or an alternative size standard test as of March 27th, which has a maximum tangible net worth test of $15 million and an average net income over 2 fiscal years of not more than $5 million. To complicate it a little further, for restaurants and hospitality businesses, which were NAICS code or our NAICS code 72, the affiliation rules were waived for purposes of the PPP. And we'll get into this a little later, but that's why we've seen very large public companies in those industries able to get loans even over the maximum $10 million limit in the loan program because they're essentially able to apply on a subsidiary by subsidiary basis, which essentially means a location by location basis for a lot of those companies. I guess, Allison, what I'd say is if you're a business that might fall into one of these alternative tests, the rules are a little nuanced. A lot of them are historical SBA rules. And if there's a question about it, I would encourage people to contact us to do a thorough analysis on that.
Thank you. That's really helpful. So, Andrew, there's been a lot of conversation over the last 3 weeks around the question of economic necessity, the good faith certification that borrowers have to make when they take out the PPP loan. And in particular, this question of what economic necessity means, which seems to be a somewhat changing standard as we speak. And I'm hoping that maybe you can walk us through some of the conversation around this issue as it matters right now, especially because I think it's going to be one of the focal points for audits that follow receipt of this money.
Yeah, no, absolutely. And I think, looking back on the work that we've been doing over the past several weeks, as Chris was just mentioning, when the program was first announced, certainly most of our initial focus in helping clients was trying to figure out, okay, do you qualify for the loan under one of these different qualification standards? And there was certainly some uncertainty around some of those, and we had to spend a lot of time helping clients just figure out how do you count your employees and do you even meet the standards here? Now that we've kind of shifted past that initial rush of applications, really the focus has started to shift to the issue of the economic justification for taking these loans. And a lot of that, as we're going to discuss as we move through the slides, is being driven by media scrutiny of the program and how the administration has been responding to some of that scrutiny. And I think the other big issue that people are really looking to now moving forward that we'll also talk about later are issues related to loan forgiveness. So just turning to the economic justification issue that we're all really starting to focus on now. Like everything with the Paycheck Protection Program, it's a complicated issue, and it kind of sits at the middle of both legal issues, political issues, and then practical issues for how you manage the risks around this. Just as you mentioned, Allison, because there have been indications that there are going to be audits, and this is likely going to be one of the key areas that's looked at. So let's start then with setting the ground rules for kind of what the legal issues are here. The CARES Act in the statute itself, and then in the application that goes along with the CARES Act for applying for PPP loans, requires borrowers to make certain certifications. One of those is that the uncertainty of current economic conditions makes necessary the loan request to support the ongoing operations of the eligible recipient. I think at the time that a lot of borrowers were applying for loans, the view was certainly that we're all facing economic uncertainty right now, given what's going on with the COVID pandemic. And therefore, I think there was not much concern from most applicants who were submitting these applications that they didn't meet that standard, particularly given that there's really no guidance out there on what exactly that standard means. I think there's obviously a tremendous amount of economic uncertainty out in the market, but what does it mean that uncertainty makes it necessary for the loan? What does it mean that the need is to support the ongoing operations? There wasn't any clarity on that, and I think even now there remains uncertainty. What we do know, though, is that the CARES Act itself does not include any kind of a means test or an express liquidity test for obtaining a loan. Essentially, you've got the qualification criteria that our colleague Chris talked about a few minutes ago, and then you've got this uncertainty certification that needs to be made. What's interesting, though, is that the CARES Act does expressly waive kind of a standard SBA test that exists for loan applicants relating to basically demonstrating that you can't, as a borrower, you can't obtain credit elsewhere. So the SBA expressly waives that, which seems to raise questions about or support the view that there isn't necessarily a means test connected to the CARES Act, given that it's actually waiving what typically would be somewhat of a means test baked into standard SBA practices. And under those standard SBA rules, you would look at kind of the applicant's business and the resources they have, and even look at some of the resources of the principals to determine whether they can pass that test. So that was kind of the legal framework that exists. But what we've been seeing is that in the weeks following the application process and the making of loans that went out, there was a lot of media scrutiny and reporting that was done about larger companies, public companies, even very well-known companies that were obtaining these loans. And the reporting there kind of focusing on the fact that this program which seemed to be focused on small businesses, but here are businesses that the public might view as traditional larger businesses or very successful businesses. And you can kind of see some of the headlines and some of the different publications that went out on that. And, it's interesting, some of the scrutiny focused on particular industries, maybe, restaurant and franchises or the hotel or accommodations industries, even though the CARES Act itself specifically had carve-out provisions to help ensure that some of those entities were able to participate in this program. So that kind of set the stage for how the administration has responded. And so, Chris, I can flip it back to you to talk to us about how the administration has moved forward from all of that.
Yeah,
Sure.
Thank you.
So
Thanks, Andrew and Chris. If you want to go ahead and walk us through some of that response, that would be great.
Yeah. So if we go to page or slide 9, the administration response to concerns about large borrowers. Probably a lot of people are aware of this. The Wall Street Journal published a list of public companies that had received PPP loans in the early days after funding was opened up. And there was really a media firestorm about large companies getting funded, particularly in light of the fact that a lot of small companies didn't get funded in the first tranche of funding. And Secretary Mnuchin came out publicly and said that people must have misunderstood the certification requirements, the one about current economic uncertainty making the loan request necessary, and said no, that certification requirement always included a liquidity test, and as a result, Treasury came out with FAQ number 31, which essentially reads into the certification requirements a question about whether the applicant has the ability to access other sources of liquidity sufficient to support ongoing operations in a way that is not significantly detrimental to the business, which is obviously a vague standard that can be difficult to apply, but in the face of the criticism, they made it clear that there was skepticism about whether large public companies, at least with access to public markets, could make that certification in good faith. And then also made clear in FAQ 37 that this applied to private companies as well, who might be able to access sources of liquidity. I think it's fair to say this has been one of the most frustrating and still fluid aspects of the PPP. This has resulted in a number of clients looking at this, what is really a new liquidity requirement, and reassessing their eligibility for the PPP program and either not taking funds or returning funds. And Treasury itself has indicated that they're going to come out with additional clarifications as to exactly what this liquidity test means. We haven't seen those yet, and we can get into some interpretations of about what we think that test may mean. If you flip to the next slide, slide 10, the SBA has indicated that every loan in excess of $2 million is going to be audited, and the SBA has said that it will review loans following the lender's submission of the borrower's loan forgiveness application. And again, that additional guidance will be forthcoming, but we haven't seen it yet. So this has been a little bit of a frustrating exercise for borrowers to try to understand the basic elements of eligibility, particularly in light of this what really is a new requirement to assess alternative liquidity. We can go to the next slide, slide 11. And Andrew, I can ask you, in your view, what does this test mean?
Yeah, and I know that everybody that we've got doing this presentation has been answering a lot of these questions, and we don't have, I don't think, any definitive answer that we can give, but I think we can certainly help provide some perspective and some guidance on how we think companies should be thinking about this. And there's a number of different factors, and I think at the end of the day, it really is kind of a totality of the circumstances type assessment that you need to make, because there are so many different issues that impact a business's ongoing operations and the economic uncertainty that's occurring at the time. So, as a result, we have been advising a lot of clients to probably document kind of what some of your financial and operational justifications are, so that you have kind of a contemporaneous documentation explaining and supporting your view as to why you meet this certification test that's being put out there. Some of the factors, and there certainly could be other factors, but Certainly some of the bigger factors would be things like liquidity, access to capital, ongoing operational revenue, any changes there, increase or decrease in recent businesses, activities or expectations of business, aging of accounts receivable, whether a business has already faced layoffs or whether it's pretty clear that they're going to have to do layoffs without financial support. Even, operational challenges can be particularly important. I think if you're in a business that is basically been shut down, there are certainly certain industries out there that because of social distancing requirements or shutdown orders are really unable to operate and generate revenue. Even issues such as sick employees, if you're really struggling because of the nature of your business and being able to operate because of the impacts of COVID, that's certainly important issues. So I think that, looking at all of these factors, it's not necessarily a matter of being able to check every single one of these off to say, we have problems on every single one of these. But on the whole, do you have reasonable stories to tell about where the financial and operational challenges are being faced? Chris, I know that you've also been working with clients to assess some of these issues. I don't know if you have any thoughts that you'd like to share as well.
Well, I think it's a vague standard at best, and a difficult one to apply. And as written in the FAQ, it does say that these alternative sources of liquidity, whatever they may be, are ones that the business can tap in a way that is not significantly detrimental to the business. So it's not clear exactly what that means, but it seems to me that a business could have access to liquidity, but if tapping it has a significant detrimental effect on the business, you may still qualify. Again, as Andrew says, there's really a mosaic of facts and circumstances that would have to be analyzed. Some cases are not close. Some companies have no liquidity, or no access to liquidity. Some cases, I think, have been not close on the other end, with companies that have ample access to liquidity that they could tap without a material detrimental effect. And there are a lot of cases in the middle. And as I mentioned before, Treasury is telling us they're going to come out with additional guidance on this point. They've pushed the date out to May 14th when clients have to make a decision of go, no go in terms of eligibility, at least to do it within the safe harbor that's been set up. So I would
Chris,
encourage people to, go ahead, Allison.
Yeah, no, I was just going to ask Chuck also, who is also a partner in our corporate practice, kind of, in line with what you're saying, what he's seen in his practice, because I think that from the perspective of looking at corporate governance issues and transactional issues, both of which you and Chuck do a lot of work in, I think this is particularly important. And so, Chuck, I don't know if you have additional thoughts you'd like to add here before we turn to another component of what we expect will be a source of audits.
Sure. Thank you, Allison. And obviously, in the midst of all this uncertainty, the practical question is, what should I do? What's a responsible way to react to all of these mixed signals that we're getting from the government and lawyers on webinars all the time telling us that it's not clear? And we will outline in a couple of slides just very practical things you should be doing at the board level before the 14th of May. Originally, we thought it had to be before tomorrow, but now that we have this brief reprieve, things that you want to do before the 14th of May, and then similarly, things that you want to do between the 14th of May and when you seek forgiveness, and just practical things. The good news is that you don't have to make the perfect decision. You simply have to make a certification in good faith. And to Chris's point that there's a lot of area that's gray, if you're in that gray area, like I expect you probably are if you're taking the time to be on this webinar, and then being certain that you document your thoughtfulness and your respectful treatment of the guidance that we do have in making whatever decision you make. So I think that this scenario is going to reward people who are careful and properly dot their I's and cross their T's.
Thank you. That's really helpful. And thanks for your insight, Chris and Chuck and Andrew. So we expect, and obviously, as everyone has said, we don't have guidance, precise guidance yet from the SBA about what the contours of an audit will look like. But we expect that the audit will certainly focus around two issues, one of which is this good faith certification that we were just discussing. And another is this issue of forgiveness, because obviously what makes this so appealing as a loan is that all or most of it could be converted into a grant at the end of the 8-week period. That's the covered period. And how do you go about making sure that you're able to avail yourself of the forgiveness option of this loan? And Meredith is going to walk us through some of those very specific details as well. And then, as Chuck mentioned, we'll talk a bit about some of the practical considerations of thinking about an audit. And then we'll also discuss how an audit could be used in predicate fact-finding, which we'll talk a little bit about at the end. But Meredith, if you can walk us through some aspects of the forgiveness component of this, that would be very helpful.
Sure, thank you. So there are two considerations once you get your funding, and those are how do you spend the money in line with what the statute requires, and the second is how do you spend the money in such a way that you are going to maximize your forgiveness. There's a slight difference between the two aspects of the law. The funds can be used for payroll costs, and those are your salaries, your benefit payments, sick leave, retirement, state and local taxes. It's on interest for mortgage obligations. It can be used on rent, and it can be used on utility. The money can also be used for interest on other debt obligations, certain other debt obligations. However, there are some limitations on even in that compensation piece of the use. You cannot use this for the excess of salaries over $100,000 for employees who have a principal place of business outside the U.S. or for leave wages that are already covered under the Family's First Coronavirus Response Act, which is a different piece of legislation that was enacted in response to the COVID pandemic. Now, just as a tip, and I think that Chuck will talk about this later in talking about the audit, we've been recommending that in order to be able to account for how this money has been spent, that you segregate the funds and carefully track all of your expenditures. So that's just on the front end. When you're spending your money, you want to make sure that you're doing good record keeping, and we can develop that theme later on in the discussion. With respect to loan forgiveness, you are generally able to seek forgiveness for the categories of expenses that I just described, except interest on debt obligations that are not mortgage obligations are not eligible for forgiveness. Now, there's a big overarching ratio that applies to how you use these funds, and that has evolved as the rules have developed and have been modified over the course of the rollout of this program. But the current interpretation of the rules is that you have to spend at least 75% of your PPP loan on payroll expenses. And according to the government, that is to, serve the purpose of the act, which is to help Americans stay employed during this crisis. Now, you still are eligible for up to 25% of the proceeds being used for mortgage interest, rent, and utilities. There are, however, other considerations that may affect your payroll calculation. We could have the next slide, please. There are two buckets that could affect your payroll or your forgiveness calculations, and that is reductions in your full-time employee workforce and also reductions in the payroll expenses themselves and salaries and wages to your employees. We could have the next slide, slide 15, please. What the SBA is going to look at when you are seeking your forgiveness is whether you have retained the bulk of your employees during this 8-week period that follows the dispersal of the loan. And what they're going to look at is the number of the full-time equivalent employees you had in this 8 weeks after the loan is provided to you, and they're going to look at a benchmark, which would be one of two periods. The first period would be February 15th, 2019 through June 30th, 2019, or the second period is January 1st, 2020 to February 29th, 2020. And you can choose the more favorable of those periods. So if you had fewer employees in January 2020 to February 2020, you would want to use that and compare your 8 weeks after you get the loan to that lower number. So it's going to be a ratio. Ideally, your ratio would be, 100 employees in the 8 weeks after you get the loan and 100 employees in February of 2020, and you're good. But chances are there's going to be some difference there. And if it's 50 employees in the 8 weeks after you get your loan and 100 employees in that January and February timeframe, you're going to be looking at a reduction there that is pretty substantial. Similarly, the SBA is also going to look at your salary reduction. Any reductions of 25% or more for an employee who made under $100,000 a year is going to negatively affect your forgiveness calculation. Now, there is an opportunity to fix this if you are able to rehire employees who were laid off between February 15th, 2020 and April 26th, 2020. You can restore those employees to their positions and cure that deficit. Same with their for salary cuts. If you restore salaries to where they were before you reduce them, that can also help to cure your any deficit. Now, there was a new piece of guidance that came out a day or two ago, which addressed the question of, well, what if I had an employee, I laid him or her off, I asked him or her to come back, and they said no. Does that negatively affect my forgiveness calculation? And the SBA has come back and said no, as long as you put that in writing and the employee refuses to come back, then that is not going to detrimentally affect your forgiveness. However, it cautions that it could affect the employee's eligibility for unemployment insurance. So those are some discussions that employers may find themselves having with employees as the weeks go on. In general, though, again, these are issues that you're going to want to make sure as you go through this process that you're documenting everything. If you are asking employees to come back and they are saying no, you're going to want to keep good records of that, because all of that is going to factor in down the line when you do seek forgiveness or your files are reviewed. With respect to the forgiveness piece, the statute indicates that you're going to have to submit your payroll records, documents that validate the expenses that you paid for your mortgage interest, your rent, your utilities. And I expect that there are other documents that inform how you use these funds. The bank and then ultimately the SBA could ask you for those. So that's a high-level overview of that process.
Thank you. That's really helpful. I'd like us to focus a bit on how we should be thinking about audits and preparing for audits today and tomorrow. If we could go to slide 18, please. I'd like us to be, considering that. And Chuck, if you can walk us through that, that would be really helpful.
Certainly, Allison. Thank you. So first, let's level set just a little bit. The SBA has made it clear that for any loan in excess of $2 million, you will be audited. So it's not a matter of if, but when. There are more than, I believe at last count, 26,000 recipients of more than $2 million, which means that there's going to be this wave of audits. We think it's going to be very difficult for those audits to be completed, and as a result, our belief is that for those who receive less than $2 billion, and particularly much less than $2 million, that you're very unlikely to be audited. One of the attendees asked a question about that. But it means that if you were successful in getting more than $2 million, you should anticipate an audit and be thinking carefully about what you want to be able to demonstrate around that audit. So the first is, as we've already discussed, you want to be able to document the consideration that went into supporting your conclusions that the loan is necessary to support the ongoing operations of the applicant. So what does that look like? That should look like specific memoranda outlining your thinking along the lines that we explored earlier in this presentation. And remember again that your thinking doesn't have to be perfect, but you do want it to be contemporaneous, and you want to speak to both the time when the application was submitted, but also to now. So for example, I appreciate that a couple of you have already commented that your situation has changed pretty dramatically between when you submitted the applications and now. And remember, now means simply before the decision that has to be made by next Thursday, the 14th, as to whether or not to return the money. But that at both of those points in time, you feel confident making the certifications in good faith that the current economic uncertainty makes this loan request necessary to support the ongoing operations of the application, after taking into account your current business activity and your ability to access other sources of liquidity sufficient to support your ongoing operations in a manner that is not significantly detrimental to the business. So as we're helping clients prepare these sorts of memoranda, we simply are parroting that language back and then explaining precisely the thinking that goes into that conclusion. That ideally would include financial models, outlining alternatives. For example, what would happen if you didn't get the loans? Would you be forced to lay people off? What would your operations look like? You would consider the terms and conditions of potential access to other capital. So, what are the interest rates? If you happen to be a nonprofit and you have endowment money or quasi-endowment funds, are they restricted? Do you even have the ability to access those funds given the limitations placed on those funds by the donor? So, get down into the weeds like that. The model should capture relevant real-time data that explains them. So that we expect, for example, more unemployment numbers coming out later this week. Those are sobering numbers. If I know there are a number of attendees on the call who are schools. There's news of schools closing because of the uncertainty. You may want to capture that, and if your board is considering such things, make sure you're documenting that. Be certain to be specific about anticipated impact on staffing. Prepare a written report reflecting all of these conclusions. Discuss at your board level. So if you're the business that has an active board, I would want the board to actually review this written material and to vote, assuming they've already voted to submit the application, but to vote again not to return the money, given the full benefit of all of the thinking. And the minutes of that board meeting should carefully reflect all of these considerations. And that's what you should be doing today in a proactive way. The good news is that if you haven't done this, you've got another 8 days to do it, given last night's extension. And if, as you go through that exercise, you feel confident that you can thoughtfully outline that case, then you'll help to insulate yourselves from the audit and any suggestion that anything was improper. Now, let's assume you get over that hurdle and you don't send the money back. and you know the audit's coming, what can you do to responsibly prepare your forgiveness application and prepare for the audit that will follow? So the first thing is I would be certain to have a file that is already being built that you anticipate simply turning over to the auditor. That would include all of the calculations and supporting material submitted as part of the initial application, as well as the memoranda that I just described and whatever models are prepared as part of that. That file should include your board resolution, all of the material that was provided to the board as part of the analysis, and just presume that all of that will be provided as part of the audit. So just begin building that file. We've already mentioned our advice to segregate loan proceeds. Some banks are even requiring that. It will make it that much easier to track exactly where the money is going. We have a particularly, our view, conservative view, is that you have to spend 75% of the loan proceeds on payroll in the 8 weeks in order for you to be eligible for forgiveness. That's proving to be, for many clients, pretty daunting. And if you're going to hit that bogey, you need to be modeling that out immediately and be certain that you're on a path to accomplish that. And by segregating out the loan proceeds and being certain that it's being spent the way it has to be spent, we're finding that that's helping people feel confident that they're going to be able to achieve that. There are a number of questions that have been asked about how you sort of count that. Hopefully we'll be able to get into some of the nuances of it. If we're not able to, feel free to call us and we'll try to be helpful, because the devil really is in the detail. But you want to be able to track those expenditures carefully. You need to follow and document the direction from your lenders. So in certain circumstances, we believe that the guidance that people are getting from their lenders may be inconsistent with our read of the regulations. But practically speaking, it's the lender who's going to make the initial call about forgiveness. So to the extent you're asked by your lender to do something or frame something in a way that's inconsistent with the guidance that you're getting from counsel, you're going to need to be able to document that direction and hopefully be able to satisfy both. But it's at some level, the banks are really driving this. Next, we encourage you to assemble documents relating to the expenditures. So for example, if you intend to spend loan proceeds on lease payments, go ahead and just copy that lease, put it in the file. Know that there's not going to be any questions about it. Hold on to those utility bills. Be certain that you're adding those to the file so that when the audit comes, there's just no question about it. And then finally, we're encouraging people just to be doing all of this in real time so that you don't get to the end of the 8 weeks and find yourself scrambling. Particularly if your loan's for more than $2 million, you know you're going to get audited. You're going to be asked for these things. So it's just prepare for it and do so thoughtfully and responsibly, and hopefully that process will go as smooth as possible.
Thank you, Chuck. That was really helpful. I wanted to speak a bit about what we can expect during the audit process itself, understanding, of course, that at this point, the SBA hasn't given us all of the guidance around what that process is going to look like. And if we can advance to slide number 22, please, that would be helpful. So first of all, we expect that in light of the numbers of, borrowers that have loans in excess of $2 million, most of these audits, many audits are probably not going to be super granular. But we do expect that some number of the audits will be particularly granular, and we'll focus on a lot of the particulars that Chuck just discussed. So a few things. First of all, we expect that the audits will be conducted by the Small Business Administration's Inspector General. That seems to be what's contemplated both under the program itself. The CARES Act itself seems to contemplate additional money going to the SBA's Inspector General office for purposes of auditing this program. And to date, it's been the SBA that's been announcing its intention to engage in these audits. So that's the first thing. The second thing is that the expectation is that these audits will happen at the point in time when a borrower seeks forgiveness of its loan. And so the way this works, as everybody I suspect knows, is that your loan forgiveness covered period is 8 weeks. It's the first 8 weeks during which time you have the loan. Sometime toward the end of that 8 weeks, there's an expectation that borrowers will file a forgiveness application with their bank, and that their bank will in turn spend 60 days, probably in connection with the SBA, reviewing that application. And during that point in time, during that forgiveness period, that 60-day period, there's an expectation that that's when these audits will, for the most part, occur. So I tell you all of that because it means that there's a lot of audit activity that would necessarily occur during a fairly compressed period of time if we are to believe the current statutory regime that's in place, meaning that there's no other guidance that comes out that suggests that maybe the audit period extends beyond that 60 days, which seems likely impossible. And so I think it's important to know that if you have a loan of more than $2 million, as the SBA has promised, and as Chuck just mentioned, you will be audited. In many cases, that audit will probably be concerning itself mostly with whether or not you have adequate documentation to support the loan you took in the first instance. So did you adequately show you had the payroll that you said you had? Did you show that the numbers of employees who work for you are in fact really your employees? Do you have, payroll logs or something to that effect that show and prove that you were in fact eligible for the loan? Are you really a business that has fewer than 500 people or 500 employees, or are you subject to some other exception that enables you to be eligible for the loan? And then, of course, I think the other two aspects that will be particularly scrutinized are what we've been discussing. Did you take the good faith? Did you take the loan having made your good faith certification, namely that the loan is necessary due to economic uncertainty, and that to the extent you have other sources of liquidity available for the business, those other sources of liquidity are not adequate here, and that if you were to tap those other sources of liquidity, there would be significant damage done to your business, harming your operations. Those seem like eligible components of any audit, and I would bet that to the extent the SBA does audit your business, that they're going to look at your eligibility, both along terms of payroll attestations as well as size of your business. They're going to look at the good faith certification, and they're going to look at the way that you've used the loan proceeds. As Meredith explained, the loan proceeds can be used to make payroll. They can be used for mortgage interest. They can be used for rent. They can be used for utilities if you're seeking forgiveness. In addition, you can also use the loan proceeds to pay other existing debt obligations, but that payment of other existing debt obligations does not factor into a request that you make for forgiveness. It cannot. So there's a discrepancy between what's eligible for forgiveness and what's an eligible use of the loan proceeds themselves. And I note that because I think that that's a question a lot of folks have been asking in this program. And I suspect that on the back end, when you go and you seek forgiveness from your bank, that the audit that ensues, if there is one, will focus along those lines of, have you shown that you use these loan proceeds as you're supposed to? Have you shown that you've used these loan proceeds, at least 75% of them, for purposes of making payroll? Have you done an adequate job of documenting those payroll expenses? And have you really done a thorough and meticulous job of showing the connection between the monies that you received from the loan and the payments that you made for payroll and other permissible payments, including, as we've said, mortgage interest, rent, and utilities? I think having very good documentation around all of those points is going to be mission critical here, especially if you have a loan for more than $2 million. Now, the SBA has not said that if you have a loan for less than $2 million, you're not going to be audited. I suspect there will be some discrete number of recipients of loans that are smaller that get audited as well for other reasons. Some reasons that you could get audited, for example, are if you have a particularly unique aspect to the way your business is structured, such that the SBA might want to probe a little bit and make sure that you're in fact a business that even in the aggregate with your affiliates doesn't trigger or doesn't tip that 500-person number for employees. In some cases, banks are asking, and I think we spoke briefly about this earlier on this webinar, but we've seen instances where banks are asking their borrowers to sign additional documentation around their borrower's certification of its own eligibility. And that documentation we expect is being forwarded as part of the borrower's application and loan documents to the SBA. That could trigger in some discrete instances an audit. And I should note that just because you get audited doesn't mean anything's wrong. It doesn't mean you did anything wrong. And in most cases, those audits aren't going to go anywhere. They're just going to be, checks that the government is doing, in part because of a lot of the pressure that has been made public now around the use of this money. I don't think in the last 2 weeks have opened up a newspaper and not seen an article around how this money has been used by companies that are small businesses, and also questioning whether certain categories of businesses that may technically, legally be eligible for this money should in fact be taking this loan. And so a lot of that, of course, is animating these audits, and it will continue to. And our advice is not that you shouldn't take the money if you're eligible for it. It's that you should be very careful about making sure that you fit all of these different criteria, that one, you're eligible, that two, you can adequately sign your good faith certification, that three, you've used the loan proceeds as you're supposed to, and that four, when you seek forgiveness, you are in fact doing what you're supposed to be doing and documenting very meticulously all of the ways that you spent those loan proceeds. So that's really what we're expecting out of the audit process. We hope to get additional guidance from the SBA in short order, as they've promised. Now, there's also been conversation out there about, well, what does it mean? What does an audit actually do? And how could an audit, in fact, become something bigger? And although we think that there's probably going to be very few instances where that happens, it's certainly prudent to be thinking about what an audit could result in at the very end of this process, which isn't to say that you should be scared away from taking the money, but it is to say that you should be very careful and meticulous about your own eligibility, attestations around good faith, your attestations around the forgiveness request that you subsequently make from your bank. So there are instances, of course, in other areas of the law where audits that are engaged in by agencies sometimes result in fact-finding that in turn results in a subpoena being served on the party that's been audited. In my own practice, I've done tax work, and I've also done a lot of financial services work, which is what I do currently. And in both of those practices, for example, audits sometimes inform subsequent investigations. And so we don't want to cause alarm, but we just want everybody to understand possibilities. And so briefly, I just want to talk very briefly about a couple of different theories of liability that have been floating around concerning any potential investigation that could arise from an audit. Again, stressing that you should understand all the consequences, but you shouldn't necessarily be deterred if you're otherwise eligible and you're doing everything you're supposed to be doing, and you're being very careful and thoughtful about whether you're in fact able to take this loan and properly seeking forgiveness on the back end. But there are, of course, a few theories of liability, namely the False Claims Act. In a nutshell, the False Claims Act is a law. It's called Lincoln's Law. It started in the Civil War, and it's basically the idea that the government has a way of trying to recoup monies that were fraudulently or falsely taken from the government, either because someone made a misrepresentation to the government about their eligibility for those funds, or in some other way otherwise caused the government to give that company or sometimes an individual monies to which he or she was not otherwise eligible through a program. It's not tax related. So that is one exclusion from the False Claims Act. And generally speaking, the standard speaks to knowing or reckless disregard. So it's knowing that you're engaging in a falsehood, that you're making a false statement, or that you're engaging in a way that is with reckless disregard for the truth. It is not the case that if you make a good faith certification and you've done your best to ascertain your availability of other sources of money and you document that is reckless disregard or falsehoods. And so we want to make that clear, but we also want everybody to understand that the False Claims Act is a real possibility. We've heard some rumblings about it. The other cause of action that is probably less likely to be used here is something called FIREA. It's the Financial Institutions Reform, Recovery, and Enforcement Act in 1989. It grew out of the S&L crisis a number of years ago now. And in a nutshell, that's a statute that the Department of Justice prosecutes, as is the False Claims Act. And that statute allows the Department of Justice to seek civil penalties from individuals or companies that essentially engage in a fraudulent act vis-a-vis a bank. And it allows the Department of Justice to call on existing criminal fraud laws, but to prove those laws using a civil burden of proof and to seek civil penalties. So it's not a criminal law, it's a civil law that encapsulates certain causes of action like wire fraud or making a false statement, but applies to them a civil standard. That has to affect a bank for that to be a cognizable cause of action. But we mention these two just because they're potential theories that could give rise to an investigation in the off chance that an audit goes to a subpoena and that subpoena has legs and goes somewhere. We don't expect that that's going to be the overwhelming, that probably will be a very small percentage of audits, but we would be remiss if we didn't discuss it. And then finally, recently, we note that the Department of Justice, I think yesterday, actually announced that it had filed its first criminal complaint. But in that instance, that was a situation where companies essentially were created and that they fabricated an entire payroll and they fabricated their existence in order to avail themselves of monies for the PPP. So really just pretty much garden variety, straight up fraud, which is obviously wholly inappropriate and not surprising that the government has brought its first case in this regard. So those are some of the basics around what you can expect from an audit, how you can prepare yourself for an audit, what you should be thinking about in terms of good faith certification, what you should be thinking about in terms of requests for forgiveness, how you should be making sure that you're eligible for this loan and that you are spending this money correctly. I want to thank everybody for joining us today. I'm Allison Baker, and I've been joined by my partners, Andrew Bigart and Meredith Boylan in our financial services practice, as well as my partners, Chuck Morton and Chris O'Brien in our corporate practice. I note that unfortunately we have many, many questions that we were not able to answer, although we did try to incorporate many questions into our discussion this afternoon, but you should feel free to email any and all of us with your questions, and we will obviously do our very best to answer them. I want to thank everyone again for joining us this afternoon and for giving us an hour of your time, and we hope that we've been able to answer some of your questions around the PPP and how that program is going forward. And of course, as more guidance becomes available, we will have that guidance on our website as well, so please keep your eyes peeled for that. Thank you very much, everybody.